Hi, and welcome to Summit Wealth Group's webinar on tariffs, volatility, and opportunities in an unpredictable market. My name is Nicole Davis, and I am the Director of Financial Planning at Summit Wealth Group. Summit Wealth Group is a financial advisory firm, and we put financial planning first in order to help our clients navigate a path to a better, more secure future. Today, joining us, we have four of our advisors, Scott Marks, Kurt Whitesell, Josh Jerley, and Nate Archuleta. Thanks for joining us today, guys. As we go through today, during this webinar, we're really going to take a look at what you've been hearing on the news, the tariffs that are affecting the markets. You're seeing a lot of volatility. And what does that really mean for you? So before we get started into these topics, if you have questions, we would love to hear from you. Simply just email them to info@summitwealthgroup.com. Now, we have a lot of questions to get to today, so if we don't get to your question, please know that one of our advisors will reach out to you and reply to your question. So with that, we will get started. One other thing to note is that we are recording this. So if you happen to need to step away for any reason, you will be hearing from us later with a recording. All right, well, let's get started. As we know, the markets have been really volatile. We've seen those ups and downs. Nate, I'd like to kind of hear from you first. What do you think's been really driving that market volatility lately?
Well, thanks, Nicole. Well, everyone expected some form of tariffs to be put in place, but the announcement on April 2nd that detailed the methodology and the resulting size and scope of the tariffs was well beyond what most people expected. And so since then, the adjustments to tariffs and the effect on various countries has evolved to be a little bit closer to the expectations. And today we now sit at roughly the same outcome that many expected back on March 31st. But with obviously a very different reaction in both the stock and the bond markets to get us here.
Thanks. You mentioned tariffs and what's really happening right now. What do you think investors should be aware of most about this?
Well, a brief update that changes pretty frequently. So we know that a blanket 10% tariff exists on all countries, and there's a punitive tariff on China of 125%. And a 90-day pause is in place, and most recently, a major reduction to consumer electronic goods that has been put in place. So we know that the US economy had been cooling off anyways prior to the tariff announcement, but the policy unpredictability has added a lot of uncertainty and done some damage, and we're waiting to see what the lag effects would be to the overall economy. And it will take some time to heal from that. I think consensus is that the risks of a recession have probably increased, and you may have heard this term stagflation. So concerns about higher inflation and also slower growth at the same time are increasing. But we do know that the US is still a major military power. The US is a significant technological power, and we are one of the most influential, if not the most influential, capital markets in the whole world. And there's really no alternative to that.
I appreciate your input, Nate. We see this volatility, but is it normal? Are we in like a unique environment, Scott? What are your thoughts?
Yeah, thanks, Nicole. And the answer is it's never the same reason, but it's always the same result, right? We've seen volatility like this before for a different reason. I mean, we all went through COVID together, and we saw a lot of volatility circling around uncertainty, and that's really what we're seeing here as well. We're seeing a level of uncertainty regarding the final policy that we just don't know how it's all going to play out. So markets are having a hard time pricing that in. It's hard for us to say exactly how that's going to play out, but we can look back historically and say the level of volatility we're seeing right now is not abnormal. And I actually have a little chart here that I'll share with this. You share my screen here. So this chart here shows the annual returns. Here are the bar graph of the S&P, and intra-year declines are these red marks throughout each of these years. And really the takeaway I would go with this chart is you can see in almost every year, the average intra-year decline was 14%. We're pretty close to that. But in pretty much every single year, regardless of whether the market was up 30% or down 30%, we saw intra-year declines nearly 15% in almost every one of those years. So yes, volatility is normal. We see that almost every year. The reason for the volatility is always different.
I appreciate that. You are talking about normal, as volatility is normal. But how long do you think the volatility that we're currently in will last? And will ever go back to something a little bit less volatile?
Yeah, it's a great question. Now, how long it lasts is anyone's guess, truthfully. And we can't predict that any better than the next person. But we can say that historically it always has recovered. And the timeline for that is different in almost every place. But here's an interesting chart of the VIX is a measurement of the volatility index in the market. So if things are really calm, the VIX might be measured at a 15 to 20. If things are very volatile, like they have been, the VIX might go above 45 or even 50 at one point that we saw. This chart, I think, is really interesting because it shows that historically, after seeing the volatility index being priced at the higher end, in every single scenario historically, we saw above average returns from the markets after that happened. So the short answer is yes, it'll recover. No, we don't know exactly when, but it will. And when it does, historically, you actually end up with better returns after those periods than you do normally.
That's some great information, Scott. Thanks. And just a reminder, if you do have questions, to send them to info@summitwealthgroup.com. Kind of moving on through our topics, we're discussing volatility, but really looking at the opportunities out there as they currently present themselves. Nate, I'd like to kind of come back to you. How should these long-term investors be thinking about positioning their portfolios in this current environment?
I think most importantly, we should recognize that we plan for volatility. Historically, we've seen it, like Scott pointed out, but we also plan for it individually for each of our clients' unique set of circumstances. We are goal-focused, we are plan-driven, and we are long-term equity investors, and our portfolios are really derived from and driven by your most cherished financial goals to help you live fully, not from any view of the economy or the markets. So we are prepared to ride out these frequent and often significant, but historically always temporary declines. And we also trust that inside of our portfolio, the fund managers and the strategies that we have are looking to identify opportunities when these volatile periods are there, and that can benefit our long-term perspective on investing.
Thanks, Nate. Appreciate your insight. Even in these volatile markets, there's always opportunities, right? What are some that you're seeing right now, Kurt?
Well, I think that when we try to time the market based on current market events, it's almost a loser's game. I've been in business for 38 years, and I know there's been plenty of times where I've read industry magazines or authors coming out with, the next thing I need to be doing with my portfolio. And the hard part is when you're already 100% invested, how do you reposition that portfolio to take advantage of that? And, we really rely on our investment management teams to do that for us. I don't think it makes a lot of sense for us to try to outguess the people who are actually we've hired to do that on a day in, day out basis. But there are some opportunities. And some of the opportunities I see right now are the opportunity to look at your portfolios and possibly take advantage of tax loss harvesting. That's a process of actually selling assets that have lost value and repositioning those assets in something else and staying invested to take advantage of other assets that might be going up and reducing the overall tax. So it's a way to use your investment losses to lower your long-term taxes, but you're staying invested. And I think that's really a great way. The other thing that I'd be thinking about is also if you've ever looked at Roth conversions or you have a strategy for setting up Roth IRAs by taking money out of your traditional IRA and moving it to a Roth, this is a great time to be able to move more shares for the same cost. So if you moved $10,000 from an investment just a couple months ago when the market was higher, and now the market's down 7 or 8%. Maybe you could move 7 or 8% more shares for the same dollars and the same tax liability. So those are great opportunities, something we look at on a regular basis in times like this.
Thanks, Kurt. What about common mistakes they might be making during these volatile times? Is there anything you'd caution them against, Kurt?
Yeah, don't jump off the boat. I think at the end of the day, if we think about Noah's Ark, only so many people got on the ark, or so many people and animals got on the ark. But can you imagine during the rough seas if one or two of them would have jumped off the boat? I mean, they would not have been able to be picked back up. And at the end of the day, I mean, when we think about what's happened over the last 50, 60, 80 years, the markets have always rebounded from where they've gone to and much higher thereafter. So I would caution against jumping off your investment. We've really put together portfolios and that are designed to weather the storm, but also really focus back on your plan. What's your cash flow look like? How much money do you spend versus how much you're investing? And just hunker down to make sure that you're going to be able to get through it.
Thanks. I appreciate that. Josh, we haven't heard much from you, so I'd like to turn a question over to you. How are you advising clients to this right now?
That's a great question. I mean, every client situation is very unique in where they stand. So if you're still accumulating assets, you're still working, the other opportunity there is just keep your dollar cost averaging. You're buying cheaper stocks every single payroll, and you're contributing to your 401k or adding money to your portfolio. So you always keep that mindset, and it's really a little bit easier for us to advise clients in that situation because you're many years away from needing your money. But for clients who are needing to take money out monthly and they're needing to access their funds now, it's a unique time because every time we have to sell something in order to get your cash flow out to you, we'd be selling stocks at a lower point than what they were previously. So some of the areas that we are focusing on is, selling some of the things that are actually up for the year. So just because your portfolio is down overall does not mean everything is down. Fixed income is up close to a percent or two, depending on the funds that we're owning there. Even through today, international stocks are still up 6.5% year to date. So if a client was in need of cash, needed to buy a vehicle, needed a big expense, those are areas that we would be selling, directly, just because we're not selling some things that are depreciated in value just during the market volatility recently. But really, I mean, it always comes back to each individual's plan and what their time horizon is, what their cash flow needs are, like Kurt had mentioned.
Thanks, Josh. And what do you when you're talking with your clients, what is that tone of that conversation? Do you feel like people are really anxious or curious or kind of optimistic with what's going on?
Yeah, very, very anxious, I'd say, and that is a very normal emotion to feel during these volatile times. And all four of us here on this call as advisors, we feel it too. It's we never like waking up in the morning and looking, seeing the stock markets down back-to-back days as deep as it has gone so far this year, and all the what ifs that can go in your mind, and that's just anxiety creeping in, and just what if. But the reality is, it's going to be something more in the middle. You can think of worst case scenario, best case scenario. It's going to be all right. It's just going to take some time. There are definitely some clients that are optimistic overall. When they look at this and they say, "Hey, it's a good buying opportunity. I've got some cash available. I'd like to put to work." So we're seeing some of those conversations as well. But really, just overall, the anxiety and uncertainty, it is a very real emotion, and it's definitely more polarizing just because of the political environment we're in now as well. So people are paying more attention to it. But that's really the best thing I'd say is just to stay the course, talk to your advisor if you have any specific questions or any needs that are coming up in the short run.
Thanks, Josh. Scott, did you have something to add?
I did, yeah. I've actually got a chart here that I wanted to share. It appears I'm the chart guy on this one.
Yeah.
So this is an interesting chart from JP Morgan's Guide to the Markets, and it's effectively talking about consumer sentiment and how that relates to markets and returns going forward. And as Josh mentioned, there's a lot of anxiety out there. It's true. And that's been true in the past too, in various different times, whether it be COVID in 2020, or if we're talking about 2008, the great financial crisis. There's all kinds of different times in history where consumer sentiment has dropped significantly. We can see our average here at around 84.4 right now. Well, this is actually end of March. Consumer sentiment was quite low, right? And you can look back at this, and part of the reason I like this chart is it shows you the peaks of consumer sentiment were actually some of the worst times to invest historically, whereas the times when consumers felt the least confident was actually one of the best times for you to be investing. So to me, if you're currently invested, this tells me, hey, it's a good time for us to stay the course and make sure that we're invested appropriately. If we're not currently invested right now and we have money that we can put in, it's not the worst time for us to be considering doing that. Historically, we can see that that paid off a lot of dividends.
Thanks for the charts there, Scott. Great visuals. Kurt.
You. Kurt, go ahead.
Yep, I got it. Sorry, thanks. Hey, I was just going to ask you to leave that up because if I look back in 1987 is about when I got in business, and you know what, I came to work and the market went down 20% in a single day. It was a very stressful time. I looked around the office and I thought, you know, what am I doing in this job? I'm 22 years old and what the heck? A short time later, you know, the markets did rebound and came back, and the 1990s were a great time in the market, and same with the 2000s, but there's definitely been a lot of ups and downs and unforeseen, and worry is a constant. And I think that we just need to realize that, you know, if we're doing the right activities personally, as far as saving enough of our wages and putting them in the right places to take advantage of tax law, that things will work out. And that's what financial planning is really all about. And I'm so thankful that, you know, we got so many people on the phone today to hear what we're talking about, because we can't predict the future, but we have a pretty good idea that if you're not putting away 10% of your pay, you're not taking advantage of tax law, you're not insuring your family properly, those are the things you can control, and you got to make sure that you're paying attention to that. And if you are, then things will work out and life will be a lot better on the other side of all this craziness. But that's all I really wanted to add at this point.
Appreciate it. Josh.
Yeah, Scott, to this question, or to this chart that you have up here, there's a question that came in from a client, and I think this kind of pertains to that. It says, "Is now a good time to heavily invest in the market to try and catch the market while it's down?"
Generally, yes. Historically, if you invest when markets are down 20% from their highs, there are very few times in history where that didn't pay off for you. I think I might actually have a chart for this too. Hold on. Let's see. Well, this is an interesting one here. This we all remember. This feels like a lot longer ago than it was. I think it was a week and a half ago. We saw a Thursday, Friday where the markets were down over 10% in 2 days. And this chart shows the times historically that that's happened. And if you were to invest on those days, what your returns would have been over the next 1, 3, and 5 years. And I think the takeaway from this chart here is that you've got well above average returns over the next 1, 3, and 5 years in every single one of those scenarios. So the short answer is probably yes. If you have a 3, 5, 10-year timeline for your investment and you have money in cash, it's a great time for us to deploy that into the appropriate investment based on your timeline.
Thanks, Scott. Thanks for bringing that question up, Josh. Nate.
I would add to that also that, you know, we don't always have, unless maybe there's a life event or we've just been accumulating some savings, we might not always have that extra bank reserves or idle cash. So I think even more broadly speaking, the best time to add money is when you have it, and the best time to take money out is when you need it. Because again, what we're coming back to with this is that we need to have a plan and stick to it. And we should never ignore these opportunities. We want to take advantage of it. And with the higher interest rates and things that we've been seeing recently, I think there's probably a lot of us that have accumulated some of that excess cash. So the opportunity is there, but more broadly speaking, if we think about that plan, we want to have that money working for us anyways. So we want to maintain that perspective always.
Thanks, Nate. You know, we've been talking a lot about longer term, and we started kind of looking at short term. So Josh, when you think about short term, do you think investors should be, moving away from equities, or what are your thoughts for short term?
Yeah, I mean, going back to what Nate was just going over, I mean, I love that quote of time in the market is better than market timing. Just stay in the course, stay in there. But there's a couple different theories on that. In regards to shorter term time needs. When you look at dollar cost averaging, you're adding money in every single month, and when you're taking money back out, you're selling stocks along the way. But you also have to be aware of what the market looks like at the time. If you've had a significant drawdown in the market, that's what I was mentioning earlier. Just looking for the areas in the portfolio that are still positive for the year or not down as bad to be able to sell from when those things come up. But just broad stroke, reducing from 80% equities down to 60% stocks during a down market is usually not the best. There's other options available. Talking with your advisor specifically, there's less aggressive equities to own. So staying in the market, if you really, really can't handle it, buy something that has a little bit less volatility to it and still be invested in the stock market. There's things you can do there, but overall, no, you're staying on the course of the plan. Obviously life comes up and you have big needs that can hit. And so being very aware and smart about where you're taking assets from is really an important part during these time periods.
Thanks. Scott?
And one quick thing I would add to that, Josh, is that if I don't know if everyone on this call is working with us. If you are, your advisor already put your plan together with the appropriate allocation that you should have had going into this. Now, of course, we didn't know this was coming. Nobody did, but we positioned you appropriately going into this based on your timeline, based on your plan, and based on your goals. So in very few cases, barring some major life event that dramatically changes your plan, there's really no good reason for us to be making modifications to that to make it more conservative at this point. In some cases, it makes sense for us to actually be more aggressive in times like this. And in certain cases, that's a conversation that we're having.
Thanks. Those are some excellent points. One thing I would like to do to kind of wrap up our questions for this panel, and then we will address some questions that have come in through the email, which is info@summitwealthgroup.com. If you'd like to get those in, we're about to address some of those, but I'd like to hear from each of the advisors. And what do you think is that one key message you'd want every client to hear in a time like this? Nate, we'll start with you.
Yeah, I think it comes back to timeless wisdom about building wealth in whatever circumstance or economy or whatever the world is like out there. We need to focus on what we can control, number one. And if you spend less than you make, you save for a rainy day, you think long term, diversify, you seek wise counsel, all of those things, regardless of what's happening out there beyond our control, those are things that we can have confidence in and help to build our contentment. And that foundation will then see us through all of these unexpected and anxious periods of time.
Thanks, Nate. What about you, Josh?
Yeah, just staying calm. I know it's very difficult when the media is constantly hitting you up for your attention and feeding into your anxiety. You always have to remember that they are selling to advertisers and they want to make money. So they're trying to get your clicks. They're trying to get you to tune in. Try your hardest to tune it out and know that we've got a plan for you. It is going to work out well in the long run. But just keep that in mind. Avoid making impulsive decisions and keep your long-term in focus is really the biggest points I want to make.
That's so true, Josh. Thanks for that reminder. What about you, Kurt?
Behavior is key. And I think both Nate and Josh hit it on the head. And I think that at the end of the day, you got to be able to live with your investments and just having faith and, praying to God and saying, hey, God, help me get through this time. Volatility can really weigh on you. I know having been in business for 38 years, I've had those moments where I felt really terrible about where life was going. And seriously, I felt like I was on the Titanic, right? Everything's going down during 2007, 8, and 9. During the market crash in 2000 and the dot-com bubble and the challenges that went with it. But, as age is growing on me and wisdom has come along with the pain of all the volatility, I just think that, faith is such a big part of it. Not just faith in the markets, because that's there, but faith in God and what He's bringing to the table each and every day. So I just say that, think good things and they'll happen. You just got to work at it.
Thanks, Kurt. And Scott.
I have another chart. No surprise there.
Love it.
So I think Warren Buffett said that in the short term, the market is a voting machine, and in the long term, it's a weighing machine. And this really shows in this chart. We've talked a bunch about time in the market versus timing the market. There's certain opportunities we can try to take advantage of. There's certain pitfalls that we can try to avoid. But in the end, when we're looking at planning for our clients, we really have to keep that long term in perspective. And we can see here just the amount of volatility that can happen in a single year. That's the 1 year, right? As we get further down this timeline, whether it's 5, 10, 15, 20, 25 years, you see that volatility really starts to compress, and you start to see the benefits of that compounding over time. So when we look at this over a long enough time frame, which again, regardless of whether you are investing today in your 30s or if you are retired in your 60s or 70s, we're still investing over a 10, 15, 20-year timeline. There really aren't a whole lot of people that aren't in this for the long term, and we have to remember that when we're investing, especially in times that are difficult.
Thanks, Scott.
Yeah. Nicole, we had a question come in. I think this is really probably something that's on a lot of people's minds. I'll read the question and then I'll provide some response. The question is, I understand chaos in markets recovering over time. However, having so much turmoil caused by the actions of one person is unprecedented. How are you factoring that unique variable in evaluating your advice? The world order is hugely disrupted right now. Economics are being greatly impacted by politics, and the anxiety is not simply about economics, but world order. So it's a really good question. And people probably have a lot of different perspectives on that. But objectively speaking, what we're doing is we're putting our money in the great companies of the world. So really, no one person, no one policy, no one tax plan, none of those types of things will really have the ability to affect 500 of the greatest companies in the world in the S&P 500, much less the tens of thousands of additional companies out there. And I think the basic reason for that is that it's driven by what you and I need every day is food, goods and services, all of those types of things. So while there will be an adjustment period, and like Scott said, we don't know what that adjustment period would be. Business is the mother of innovation and invention. So that will adapt and it will change. And that is motivated by putting food on the table, food in our gas tanks. And I think that's what drives us. That's what we need to keep in mind is we're not investing in the markets, policies, any of those types of things. We're investing in the great companies of the world.
Thanks, Nate. Kurt.
The most expensive words in market history are "this time it's different." And ultimately, I think that I've heard that time and time again. Obviously, there are concerns and there are obviously a lot of challenges that we face each and every day. But, that's the way the market works. That's the way America was built. When you think about the challenges that we faced, our forefathers faced in front of us, I mean, life has gotten actually a lot better. It just right now it's 24/7 news and media and the things that they're trying to sell us all the time. That's why it's important you have faith that we can get through this. And like Nate said, we're investing in companies, great companies with great balance sheets and durable histories of great dividends and opportunity. So let's keep the focus on the prize because I do believe it's there for us.
Thanks, Kurt. Appreciate that. Well, time is coming up. We appreciate everybody's time and joining us today on this webinar. If you have a question, feel free to still submit it at info@summitwealthgroup.com, and we will have an advisor get back to you. Appreciate your time, and thanks again for joining.
Thanks, everyone.
Thank you.
Thanks.